America has a problem. Not with houses, not with credit cards, with cars. Right now, more Americans are falling behind on their car payments than at any point since the financial crisis. Repossession companies are working overtime. Camera cars are scanning neighborhoods. Gig workers are quietly helping track down vehicles, and millions of borrowers are discovering something terrifying: their car is worth less than the loan attached to it. But this isn't just about people missing payments. It's about a financial system that quietly turned cars into one of the most dangerous forms of consumer debt in the economy, and now that system is starting to break.
We are seeing signs that the difficulty that many Americans are having in making their car payments is a growing and troubling sign. So yes, I think as we continue to see repossessions move forward and go up, you have to also consider that many of the large banks out there, the lenders, are actually increasing their loan loss provisions because they don't expect the loans that they wrote in the past to perform at the level that they thought they would. And in many cases, they're actually delaying the repossessions by trying to work with the customers to extend their loan terms, offer a couple of months abatement on payments. So yeah, the repossession issue is a real concern at the moment.
Car repossessions in the United States recently hit a 14-year high, and this year they've already surpassed the peak from the 2009 financial crisis. That's alarming for one major reason. Consumer protections around repossessions have actually become stronger since 2008. So if repossession numbers are matching those crisis levels today, it means borrowers are likely in even worse financial condition. But the repossession industry itself has evolved. Modern repo companies don't just wait for borrowers to miss payments anymore, they track vehicles digitally. Across the country, fleets of vehicles drive through cities equipped with automatic license plate readers. These cameras photograph every plate they see and attach GPS coordinates to it. The result: massive databases of vehicle locations. If someone stops making payments, repo agents can simply search the system to see where that car was last spotted. Some companies have even turned this into a gig economy job. Drivers attach cameras to their own cars and earn commissions when their data leads to a repossession. It's passive income, but it only exists because millions of borrowers are struggling to keep up with their car loans. So what caused this? The answer starts in During the pandemic, the car market experienced something bizarre. Prices exploded, supply chains collapsed, semiconductor shortages slowed production, and at the same time, government stimulus checks and low interest rates gave consumers more spending power than usual. The result: used cars were sometimes selling for more than new ones. Some buyers were paying $20,000 above sticker price just to secure a vehicle, and lenders were more than happy to finance those purchases. For a while, it looked sustainable, but now the bubble is deflating. Car prices are falling, and millions of borrowers are discovering they owe far more than their vehicles are worth. This is called negative equity, and it has reached record levels. Today, roughly 1 in 4 trade-ins is underwater, meaning the owner owes more on the loan than the car's market value. But that's only part of the problem, because the way Americans finance cars has changed dramatically.
Well, on the subprime side of things, yeah, obviously we see people being charged 24, 25, as much as 30% interest on car loans. And that's onerous for especially the people that already have had credit difficulties. So there is a certain amount of predatory lending that goes on. And then there's other things that exacerbate it for the customers, and that is the cost of maintaining their vehicle has gone up. And as we all know, the cost of insuring a vehicle has gone up.
Decades ago, car loans were simple. You either paid cash or you financed the car for about 5 years. Today, 5-year loans are becoming rare, 7-year loans are common, and some lenders now offer loans lasting 10 to 12 years. Yes, people are financing cars for over a decade, but that's not the only change. Down payments have also disappeared. Instead of putting money down, many buyers roll the remaining balance from their previous car into the new loan. This creates a cycle: buy a car, trade it in before the loan is paid off, roll the leftover debt into the next vehicle. Repeat. Every time this happens, the loan grows larger, the repayment timeline grows longer, and the borrower builds almost no equity in the vehicle. Eventually, one unexpected expense, one job loss, or one interest rate spike is enough to push the loan into delinquency. And this system didn't evolve by accident. It evolved because of how dealerships make money. Most people assume dealerships make their money selling vehicles, but that's not really true anymore. Dealerships make enormous profits from financing. When a dealer arranges a loan through a lender, they receive a commission, and the longer the loan term, the more profitable it becomes. That creates a powerful incentive. Sales teams want the deal approved, finance managers want the loan written, and lenders are happy to package those loans into asset-backed securities that get sold to investors. The car itself becomes almost secondary, it's just the product used to generate the loan. And the longer those loans become, the larger the financial risks grow. Which brings us to the most surprising part of this entire story, because the people now falling behind on their car payments are not just low-income borrowers. Historically, repossessions mostly affected subprime borrowers, people with poor credit, low incomes, unstable employment. And while those groups still account for many repossessions, they're no longer the only ones struggling. Late payments among borrowers with average or good credit scores have doubled since before the pandemic. Why? Because the cost of living has surged, interest rates have risen, and lifestyle inflation has quietly crept into higher income households. Some studies suggest a surprising number of households earning over $500,000 per year still live paycheck to paycheck, not because they lack income, but because they finance expensive lifestyles, luxury cars, multiple car payments, expensive cities, high debt loads. When income suddenly drops, those debts become difficult to maintain.
Typically, once you start falling behind 60 days, the banks become very concerned, and they normally don't like to let it get to a 90-day delinquency. But in many cases, we're seeing that today simply because the banks don't want to be repossessing as many vehicles as should be repossessed. I think they're trying to play a little bit of a waiting game here so that it doesn't sound the alarm bells.
And when enough borrowers start struggling at the same time, the entire credit system begins to feel the pressure. Auto debt in the United States has now grown to over $1.6 trillion, making it one of the largest categories of consumer debt, bigger than credit cards, second only to mortgages. But unlike mortgages, cars lose value every year. That means the collateral behind these loans is constantly shrinking. If repossessions surge while car prices fall, lenders could start recovering far less money from seized vehicles. And that risk doesn't just stay in the auto industry, because many of these loans have been bundled into securities and sold to investors. The same basic financial structure that caused problems during the housing crisis. Now, that doesn't mean we're heading toward another 2008, but it does reveal something important. America has quietly built an economic system where transportation is financed like real estate. Long loans, rolling debt, securitized credit, and rising prices that borrowers assume will hold their value. Except cars don't behave like houses. They depreciate quickly. And when millions of borrowers realize they're trapped in loans they can't escape, the repo trucks start showing up.
I think part of the answer would be education. A lot of people are financially ignorant to a degree, and they don't actually always realize what they're signing up for and what they're getting into. And part of it is lenders and dealers trying to figure out ways to work with the customers so that they can stay in the vehicles and continue to make payments.
For now, the car debt crisis is mostly contained to the auto market, but it reveals something much bigger. Over the past decade, the financial system has found increasingly creative ways to turn everyday purchases into long-term debt. Phones, subscriptions, housing, education, and now even transportation. And when debt becomes this normal, it's easy to forget how fragile the system can be, until suddenly, the repo truck arrives.